to my channel where I discuss my financial journey. Now keep in mind, I'm not a financial planner. I'm not giving financial advice. This is just my financial journey where I'm recording my financial journey and what I invest in and what I do and stuff like that. But if you're, this is also educational. If you want to follow along with me, if you want to, also start your investing for your financial future for your family, I welcome the audience. Today I'll be discussing the top 10 ETFs as of April 19th, 2021. See how they perform as of last year during the pandemic. Even though last year in March the market took a big tumble, it dropped like 30-40% in the month of March. If you were strong and had the guts for it, you could have made a lot of money last year because the market rebounded quite nicely from the lows of the pandemic last year. Well, still going through the pandemic still, but to the lows of the stock market crash last year. So today I'll be discussing the top 10 ETFs from last year 2020 to this year 2021, and to see how they fared during this crisis. The first ETF we'll be looking at is the Fidelity Spider, ticker SPY. This ETF tracks the top 500 companies in the U.S. stock market. So the top 500 largest companies in the U.S. stock market is in this fund. And as of 2021, this fund returned 16% in return from last year. So that's pretty good, If you're with a financial planner, most financial planners cannot beat the S&P 500 consistently year after year after year. So if you're a smart investor, you just invest your money in the ETFs or the index funds, and just each month, each week, each paycheck is continuously dollar cost averaging, which means each week, or once a week, once every 2 weeks, once a month, whenever you have funds to deposit, just consistently put your money into this fund like a bank account. Just set it and forget about it. 10, 20, 30 years from now, you look into that fund, who knows, you're a millionaire. Or if you're not around to realize it and reap the rewards of it, your family, your kids, they will thank you for that. So my financial journey and your financial journey shouldn't just be for you. It should be for your families, your grandkids. You're leaving something behind for them, a legacy. So which is a good thing. We gotta think of our families. We gotta think of the future, not just today. We gotta think of 10, 20, 30, 40 years. Who knows? We may live to see another 40 years. I might live to be 100. It'd be good to know that if I live to be that long, or 90s or 80s, I have some funds set aside that I've been saving for 20, 30 years that I can use to support myself, my wife, my kids, my grandkids. It's just hoping for the best but preparing for the worst. That's my philosophy. So the Spider S&P 500 ETF, ticker SPY, tracks the top 500 companies in the U.S. stock market. Right now, it's the largest ETF in the world. It manages approximately $330 billion in total assets. Now, that's pretty good. So it must be pretty good if it's managing $330 billion in total assets. That means people trust it, corporations trust it. It's well trusted. It's a well trusted ETF. It trades nearly 80 million shares each day, and it's right now it's the most popular. And the reason it's most popular is it's traded by the top 500 U.S. stock market index. Top 500 companies in the U.S. stock market. Sorry about that. A little nervous. The next ETF we'll be looking at is the Invesco Qqq Etf, ticker QQQ. This ETF tracks the top 100 U.S. stock companies in the U.S. stock market. The SPI tracks the top 500 companies in the U.S. stock market. Now this Invesco Qqq tracks the top 100. So you're getting the top 100 biggest companies in the U.S. stock market. So you're getting the best of the best companies in the U.S. stock market, like the Apples, the Amazons, the Netflixes, all those stuff are in this fund. The top 100 companies. And this returned last year, as of this year, it returned 45% in earnings. So if you had invested your money in this fund, you would have seen a 45% increase in your fund, you know, and that's pretty good. If you're getting 45% annual return yearly, quite possibly you could be a millionaire in a couple of years. So that's pretty good. But as we all know, past performance is no indication of future performance, which means whatever return you got last year, there's no guarantee you're going to get it this year. You may get better, you may get worse, but there's no guarantee. So each year is different than the previous year. So when you're investing in the stocks or in ETFs, you gotta, you know, in it for the long run. Don't get discouraged by if the stock market goes down, or if the stock market goes down, that's telling you to buy more shares, buy more stocks, buy more of the ETF. Don't panic and sell out. If you buy individual stocks, a lot of people buy individual stocks because they want to get rich quick. Now, if you buy individual stocks, you got to be the kind of person that can do research in the companies, find out the company's financials, who their CEOs are. That's a lot of work. That's like a full-time job. You have people who do that for a full-time job, like a living, just researching companies. Now, if you're not the kind of person who has the time and the patience to research companies, then that's why I suggest you. I'm not telling you to invest in it, but what I'm doing is I'm investing in ETFs. This way I can have a broader diversification of my funds. You know, S&P 500, top 500 companies in the U.S. You know that companies do go bankrupt, companies go out of business, but the chances that the top 500 companies in the U.S. right now going bankrupt are pretty slim to none. So that's why I invest in ETFs, because the chance of you losing all your money are pretty slim. If you invest in a single company, if the company goes bankrupt for whatever reason, they're cooking the books, they're not being honest with what they're making, what they're selling, you know, before you know it, your money can, literally in a couple of days or overnight, your money can go disappear. So we all work hard for our money. We don't want to take chances blowing it all and getting somebody else rich. So that's why I invest in ETFs again. So this ETF is the Invesco Qqq. It tracks the top 100 ETFs companies in the U.S. stock market. Last year's returned 45% return on your money last year. Next one is the Vanguard Information Technology ETF. Now this one tracks all the big tech companies. It tracks 340 total positions. So it's 340 total companies in this fund. Big tech companies in this fund. So you won't find any pharmaceutical companies. You won't find any banks in this ETF. All you're gonna find in here are tech companies like the Amazons, the Apple, Microsoft, the Netflix. The biggest and the best companies are in this fund. And this one also delivered a 45% in returns from last year. So this one also did awesome. Just like the QQQ, this one also returned 45% in returns, which is pretty awesome again. 45%, almost 50% of everybody doubled. You can't go wrong with that. Next one, we got a Vanguard Gross Etf, VUG. This one is a growth fund. It doesn't just have specific sectors of the market. This one tracks only the growth fund, the companies that are growing, expanding, and growing exponentially. So you got the companies like in here, like the Apples are growing. You got Amazon's in here. You got Home Depot. You've got railroad companies. These companies are growing. They're expanding. So these are the companies that you want to. This is the fund you want to invest in if you want to growth companies. So this is also a great company. It's great fund to invest in. If you don't want to invest in individual companies that might go bankrupt, you never know. No matter how great a company is, every company has the chance of going bankrupt. Either because of the management, either because of the product they're selling is obsolete. There are a lot of big companies that were big one time, and they went belly up. So if you don't want to take those chances, invest in an ETF. It has you cover the whole industry. And this one has an array of over 250 stocks in this fund. So 250 companies are in this fund. So you're not going to really lose much. You might not gain as much as 45% each year, but you're more than likely you're going to make money on your ETF, on your fund, because this is the 250 biggest companies that are growing. Next, we have the Schwab US Small Cap ETF. Now, this ETF tracks the small cap companies, the small companies that are just coming out. Most of these companies on this list you don't even know of. Like you got Cree, I never heard of Cree. Novacure, never really heard of them. But these are the small cap companies. In this fund, you got 1,800 stocks. So these are 1,800 companies that are in this fund, and this fund tracks all the 1,800 companies. If a company goes bankrupt, it goes belly up, they drop that company out of it and stick another one in there. So the fees in this ETF are very low, 0.04% in fees, which works out to be for every 10 grand you invest, you're paying $4. So $4, it's basically, in my opinion, it's almost free. Where else are you gonna find 0.04%? No, to invest in funds. If you're to pay a financial planner, financial advisor, they're charging 2% upfront, plus whatever 1% on the money you're making on top of that. So that's 3-4% is charging you, and there's no guarantee that they won't even make any money because there's no like I said before. Financial planners, financial investors, they don't beat the market. They don't beat the market consistently. So some years they may do well and beat the market, but consistently they don't beat the market year after year after year. And in the S&P 500, average return is about 10% per year on your S&P 500, the SPY, the Vanguard. So it's very rare you're gonna find someone who can beat the market. And if there are people, and don't get me wrong, there are people who can beat the market, but you can't afford them. Most of these fund managers, they take, like, if you have $500 million to get involved with these people. So they only take the uber rich and their money. They don't take millionaires or people with just small funds. So these are for the elites, people who have corporations and everything. These are the ones these are the guys you can hire, like Warren Buffett, Dalio. These guys who are making billions for billionaires. They're not really interested in small fries like us. Next one is the iShares MSCI USA Minimum Volume Factor ETF. It sounds complicated, but this ETF is basically, if you're not very optimistic about the stock market this year, you figure, I don't know about the stock market this year. It seems pretty bad. No one's working. I don't want to throw my money away on any ETFs. But this ETF here is more a defensive approach. It only invests in companies that are that are like companies that don't go up and down in value. These are like companies that like are steady, like Coca-Cola, like say FedEx, like UPS. These are companies that Johnson & Johnson, Pfizer. These are companies that they've been around forever. They don't go up and down in value. So that if the stock market goes bad and it takes a dive, the stock price ain't gonna go down with the market, because these are steady companies that are slow and steady. They don't go up in value. They don't go down in value. They just pretty much go straight line. So you're not gonna lose your money. So if you want to put if you're not sure where to put your money, your investments, if you want to get out of the stock market somewhere safe, the iShares MSCI is a good approach. You're not gonna lose your money and your investments. You're not gonna make much money on your investment, but you're not gonna lose much on your investments either. So if you want to be safe and secure, high dividend. Now, dividend is a company that pay interest. Think of it as interest. You go to the bank, you put your money in the bank account, they pay you an interest. But nowadays, banks don't pay any interest. So you have companies that pay dividends, high dividends, which is interest, like the oil companies, like Enbridge or Suncor. You got also REITs, which are real estate ETFs. They pay dividends. Now this one is high dividends. So all the different companies that pay a high dividend are in this fund now. So in this fund, you're gonna get 4% annual payout on your investment right now. So if it just doesn't pay, 4% is pretty good, guaranteed. Year after year, 4% interest you're gonna be making on this iShares Core High Dividend ETF. HDV, there's a ticker, HDV. So if you wanna, if you're say close to retirement or you're retired, you got a lump sum of money, or you want to just save your money year after year after year, this gives you 4% interest return on your fund. So the 4% is pretty good. It's not the highest, it's not the worst, but it's steady. Now then you also got a Vanguard Qqq All World ETF. Now this one, VEU, this tracks every company in the world basically. So this one tracks the All World ETF. So this ETF tracks every company like around the world. So for this ETF, if you don't want to just focus all on American stocks, this one tracks the Chinese stocks, European stocks. It includes every single geography except for the U.S. It doesn't have the U.S. stocks in this fund. So if you're in the Vanguard VOO, the Vanguard Vti, the SPY SPY, those are all American funds. But this one is every company in the the stock market that's not in the USA or American based. So you get all the Asian powerhouses, Alibaba, you get the Swiss pharmaceutical company, Novartis, you get Toyotas, you get every company that's not in the U.S. stock market, that's based in the U.S. stock market. So this is ultimate diversification right here. So you get, you have U.S. stock market, top 500 companies in the U.S. stock market. You got the VEU, which is every company in the total economy. You've also got a Vanguard Qqq Emerging Markets, now Etf VWO. This is one of the ETFs that I invest in. Now this one is mostly focused on the Asian markets and the upcoming markets. You don't get much of Europe in this fund. You don't get North American stock in this fund. You get China, you're getting Japan, you're getting Russia, Brazil, Mexico, India. Most people say that these are the countries right now that in the next 10, 20 years, these are the ones will be ruling the world. So their economies are up and coming, and they say one day they'll pass America. So these are the countries that are up and coming right now. So this is the Vanguard VWO Emerging Markets ETF. Now there's also if you want to buy gold, but you can't afford to buy the physical gold. There's also a Spider Gold Shares, GLD. And in this ETF, you can buy gold shares. You can invest in this fund, and it gives you a percentage of the fund. But if you want to invest in gold, but you can't afford the actual physical gold, this is the best alternative: the Spider Gold Shares, GLD. Now these are the 10 of the top ETFs to buy for 2021. But the fund that I'm in right now, I'm surprised isn't on this list, is the Vanguard Vti, which is the total U.S. stock market. This fund tracks every stock in the U.S. stock market, which is about 3,400 stocks. So the Vanguard Vti gives you the large cap stocks, which are the big companies in the U.S., like the top 500, like the VOO. It also gives you the mid cap companies, the middle companies that are up and coming, and it also gives you the small caps. So the Vti, which in my opinion is the best ETF to invest in for total U.S. stock market funds, is the Vanguard Vti, which I currently I'm invested in. So that's my main in ETF is the Vanguard Vti, which I'm surprised is not listed on this list. But hey, everyone has a right to their opinion. And that's it for now. That's my VTIs. That's it for now. That's it. That's it. Everyone take care. Stay healthy. Take care of each other. And I'll see you in the next video.